Hi folks, welcome to this video on preparing a cash flow statement. So you'll notice for this company, Ping, we have a comparative balance sheet for 2009, 2010, and we also have the current year's income statement. What we need to do is we need to prepare a cash flow statement that shows us how we went from a cash and cash equivalent balance of $775,000 to $884,500. We need to allocate that difference over the three major activities in a business that produce and use cash. And that's operating, investing, and financing decisions that companies make. So now, the first thing we're going to do is we're going to look at cash flow from operating activities. And what we've discussed is that we're going to start with net income, and we're going to convert any net income amount, because net income is calculated on the accrual basis, and we're going to convert it to the cash basis. So we have to adjust our net income by looking at two areas. Anything that we booked in there that's non-cash, so we're going to have to adjust our income from the accrual to the cash basis by looking at anything that we booked in net income that's non-cash, and in this case we have a gain on an investment sale. And we also have what we call amortization expense, and another word for amortization is depreciation. So we're going to look at any of those items that are in our income statement that are non-cash and adjust the accrual-based calculation of net income to get it to the cash basis by adjusting for those two items. The other thing we're going to do is we're going to look at any of the balance sheet accounts that are non-cash, current assets, and current liabilities, and also make adjustments to net income to convert it to the cash basis. So let's go have a look now at the way we would set this up. So if we scroll down here, we have our cash flow statement for the year ended 2010, and we start with our cash flow from operations, and we're going to look at net income. That's our net income from our income statement. So to make adjustments to convert our net income to the cash basis from operations, we have to add in our amortization. So we're looking at our income statement accounts first. We have amortization or depreciation expense, and if you check your income statement, we have that at $5,000. We've also got this gain on the sale of investments, which we know is non-cash. Any gain or loss, whether it's from a sale of investments, equipment, anything like that, if it's a gain or loss, we have to adjust our accrual-based net income calculation, and we have to adjust this gain by deducting it, because we want to convert it to the cash basis. So what we've done here, if we go down here, is we've deducted the gain right here. Now what we have to look at is we have to look at any non-cash current asset items as well as current liability items and see how we'd adjust them. So if we go back here, we can see that we have accounts receivable, and we have supplies, and we have prepaid expenses. We can see that our accounts receivable increased by $20,000. So what does that mean? When our receivable increases by $20,000, we are going to have to reduce our net income on the accrual basis to get it or to convert it to the cash basis. Why? Our receivables increased because we sold more to our customers on credit by debiting receivables and crediting sales revenue. It's that sales revenue that shows up in this net income amount. But we don't want to reflect sales revenue that we've recorded based on credit sales. We would prefer in a cash-based income amount to show what we've collected in cash. And we've collected less in cash than we booked in credit sales by $20,000. So we have to reduce the net income here, because that's recording sales revenue which was $20,000 higher than the cash sales that we actually collected, or the cash that we actually collected on those credit sales. So we need to reduce our net income to convert it from the accrual basis to the cash basis by $20,000. We also saw that our supplies went up. How do we know that? If we go back to our supplies account, we saw we had nothing in supplies inventory at the end of 2009, but we had $500 in 2010. So what we need to do is we need to acknowledge that our supplies increased, and in order to adjust it to the accrual, to the cash basis, we need to reduce it by 500. Now with the supplies, what's happened is that you can see it's increased by 500. So why would we be reducing it by our net income by 500? Well, when our supplies inventory increases, that means that we bought more supplies than we actually used up in our business. We want to reflect the amount of supplies that we bought during the year, because that's what we're going to have to pay out in cash. We're going to have to pay our suppliers, people that we bought that stuff from, right? So the idea is I want to reflect the cost of what I bought and put into my supplies inventory. And that is greater than what I actually used or took out of supplies to use in my business. So therefore, because the cost of the supplies that I purchased is greater than the amount of the supplies that I used, and what I used up is what's reflected in my accrual-based net income, but I want to reflect what I bought, the cost of supplies that I purchased, which is bigger. I need to reduce my cash, my net income on the accrual basis to reflect the fact that I bought more in supplies than I actually used up. We also see that our prepaid account is changing as well. If we go here, we see our prepaid expenses came down by 500. That means that we expensed more to calculate our net income. So we did more of debiting expenses and crediting prepaids than we actually bought in prepaids. But I want to reflect what I actually bought in prepaids, which was 500 less. But I'm reflecting expenses which are higher. So to adjust, I want to increase my accrual-based net income. So I want to increase it, so I'm only reflecting what I paid in prepaids, which was less than what I expensed. So I want to add to my net income to convert it to the cash basis. So now you can see, if you go back to the current assets section, you can see I've accounted now for all three of the current assets that are non-cash. I don't deal with my fixed assets here because that's land and equipment. Those are related to investing activities. So now what I'm going to do is I'm going to go have a look here at my cash flow statement and see that I can now start to look at the liability parts, right? So now I'm going to go to my liabilities. So if I now go into my current liability areas, I see I have two current liabilities, both of which have increased. My accounts payable have increased and my taxes payable have increased. So what's going to happen when liabilities, current liabilities of any kind, increase? Well, that means that my liabilities have increased because I bought more here with accounts payable. I bought more than I actually paid down or paid back to the people I bought them from. How else would a liability go up? With an account payable, that means I must have bought more than I paid down. I want to reflect what I paid down. Similarly with my taxes payable, they went up. I want to reflect not the amount they went up by, but what I paid down in taxes to the government. I paid down less in taxes than I actually incurred in tax liability this year, and I paid down less in accounts payable. So in both cases, I'm going to increase my net income. Why? Because I paid down less, and I want to reflect only what I paid down when I convert my accrual-based income to cash-based income. I only want to reflect what I paid down, which is less than what I incurred when I increased my payable and when I increased my taxes payable. So now I want to add 5,000 and 16,000 respectively to convert my accrual-based income to the cash basis. So now when I add up my adjustments that I got from my income statement and my non-cash current asset accounts and my current liability accounts here, I can see that my cash inflow from operations, when I also add in my 200,500, is going to be at 204,500. So that's going to be my cash inflow at net from my operating activities. Now I have to look at cash flow from investing activities. Well, I only had 2 investing activities. How do I know? If I go back here, I can see that I have a long-term investment account, and that went from $35,000 to $30,000. That means it went down. But I also figured it would go down because I must have sold a $5,000 investment. But it said here that I had a gain on the sale of that investment. So now we kind of have to sleuth this out and say, well, how much cash did that generate? Well, let's go down here into the cash flow statement and start doing a little bit of work. I could see here, if I just plop down here, I can see that I got rid of a long-term investment for $5,000 and I recorded a gain. So what I need to do is kind of recreate using a journal entry what must have happened. Well, if that means that to balance this, I must have recorded cash or got cash of $7,000 when I got rid of this long-term investment. What it tells me is that I got rid of a long-term investment for $5,000. That's how I went from $35,000 to $30,000. The income statement told me that when I sold it, I booked a gain of $2,000. So that means to get the gain, I must have taken in $7,000 in cash. So that's why I said here, when I sold the investment, I got $7,000 in cash. But I am also noticing here, gee, I put a purchase of land for $110,000 and I used up cash. How do I know that? Well, let's go back here. I could see here that my land went from $50,000 to $160,000. The question didn't say that you took out a loan for it. It didn't say anything like that. So you must have paid cash for it. Otherwise, we'd have told you didn't. But you did. The only way you could have done this is to pay cash, because we didn't tell you that you bought land and you incurred a note payable or a loan payable, or that so you have to assume that you paid for the whole thing in cash, right? So that's how we know. So we know that we paid cash for land, $110,000. So that's why we've got it here in our cash flow statement as an outflow. Now, the one other thing that students might look at here is they might say, well, how about any other equipment? Did anything happen in the equipment? Well, no. You can see here you had equipment on your records at $50,000 and you still have $50,000. So that tells us that you didn't buy any and you didn't sell any. The other clue here is that we can see accumulated amortization or accumulated depreciation went from $25,000 to $30,000. That must have happened as a result only of the depreciation or amortization that you booked this year. That's how it went from 25 to 30. So you know that there were no purchases of equipment, no sales of equipment, nothing else happened. So you know nothing happened in the equipment account. The only thing that happened in your property, plant, and equipment was the land. And the land went from 50 to 160, so that tells you that you bought some land. You must have paid cash again because we didn't tell you you took out a loan or anything. So that's how we know nothing happened in the equipment area and it was just a land purchase. So we know that we used up or had a net cash outflow from investing of $103,000. Now what we want to do is we want to look at what happened in financing. So now we can see our common shares went up from 195 to 215. So what does that tell you? You must have issued shares, right? You must have issued $20,000 in shares. We also know here that your loan payable went from $40,000 to $36,000, so you must have used cash to pay down some debt that was used to help you finance your business. Somebody gave you money, so you got a loan. So you paid down $4,000 of it. So that's a financing outflow. Whenever you get money in to finance your business, it's a financing inflow. So when you pay it back, it's a financing outflow. So that tells us that we used up cash to pay back loans of $4,000. We also got cash from our investors, $20,000. And we also know here that our retained earnings went from $678,000 to $870,500. We actually told you a lot about this. We told you here that that happened not just because of income, but also because of the fact that you declared and paid dividends of $8,000. So we gave you the dividend paid amount here, which was $8,000. We may not on the exam. Who knows? We may not. But you would always know how to calculate it. You could do a statement of retained earnings or run a T account for retained earnings, right? To say I started retained earnings at $678, I increased it with net income, but this is what I got in retained earnings. So I must have debited retained earnings when I declared dividends of $8,000. And it says the dividends were declared and paid. So whatever you declared during the year, you paid $8,000. So that's a cash outflow, which is financing. So now if we go down here, we could see, well, we got that. We got the payment on the loan, which is an outflow. The shares, which we sold to our investors, which they gave us $20,000 for, it's an inflow. And dividends we paid to our investors, which is an outflow. So at net, this is an inflow of $8,000. So that means my net change in cash, which represents an increase in, again, it's cash and cash equivalents, right? 2045 from operating, less 103 from financing, plus 8 from less 103 from investing, plus 8,000 from financing, in total gives us a net inflow of 109,500. To that we add our opening balance in cash and cash equivalents, which is 775, and that gives us our ending balance in cash and cash equivalents of 884.5. So if we go back to your balance sheet for the current year, that is exactly what you should have, 884.5. Now notice in your cash flow statement two more things. It's for the year ended because you're trying to reconcile the opening to the ending balance of cash and cash equivalents. So it's for a period, in this case a year. And notice the order. We go operating activities, investing activities, and then financing activities. And the last thing you do here is you do the last three lines to help you prove the cash balance. And that is always part of your cash flow statement. So this concludes our short video on preparing a cash flow statement.